This is going to be a brief lecture, not very lengthy one. Now, since I have already covered break-even point analysis, I am going to cover it again, focusing on the types of questions that you can expect in the test. There will be quite a number of questions from break-even point analysis. So let me walk you through as to what you can expect. The first thing that you can expect is what is the utility of break-even point analysis. So it may not be a straightforward question like what is the utility of break-even point analysis. There may be multiple options. So for example, break-even point analysis is highly approximate because it is based on projected financial data, which may or may not actually manifest in the way we have projected. So that may be one of the accurate statements, but there may be 5 options or 4 options. Other options may be even more accurate. So you have to identify which one is it may not be too ambiguous, like which one is more serious is an ambiguous question. It may not be that ambiguous. It will be straightforward, but then you need to know the you need to have in-depth knowledge about break-even point to be able to answer. So one is that break-even point analysis is based on projected data, meaning what is going to be your selling price, what is going to be your variable cost per unit, and the fixed cost that you already know. Perhaps only fixed cost can be estimated with fair degree of accuracy. Rest of the things may go haywire because you do not know what is going to be the raw material price moving forward. Price changes, there is inflation, there is deflation, time and again during the year itself. So things may go haywire. So first thing needs to be known is the limitations of break-even point, where for which there are slides. I think on 2 occasions I have mentioned about limitations of break-even point. If there is any doubt, you can raise issues. So you can expect question from here. Say a fixed cost actually is assumed to be fixed cost, which may vary. Why it may vary, you do not know. Maybe you have a rent agreement for a year. Next year, when you try to renew the rent agreement, maybe the house owner, landlord may demand more rent. So rent may go up, salary may go up, many things may go up. Nothing actually is constant. Suppose you have permanent employees. So even permanent employees will be expecting some increase in salary. Normally never the salary is absolutely fixed. There is an element of inflation in the salary, particularly for government employees. There is always inflation factor, so they give DA. Even private companies also, many of the private companies, they have DA structure. So perhaps every 6 months, and in some companies every 1 year they will be reviewing the salary, and the salary may go up. So depending on that, your salary goes up. Salary is considered to be a fixed cost, and if you have a 7-year horizon, you consider that throughout the 7-year salary is going to be fixed. That is why one of the limitations is fixed cost may not remain fixed. Right. So the first sentence is fixed cost may vary with turnover or with time. Over time, it may not remain fixed. Number 1, variable cost may go down as sales increases due to economy of scale. If you buy 1 kilogram of something, say you go to Tech Market and buy 1 kilogram of rice, they will charge 35 rupees. Now you tell the shopkeeper that rather than 1 kilo, I would like to buy 10 kilo. What will be the rate? He will immediately reduce the rate by a rupee or 2. Then you tell him that I want to buy a whole quintal of rice, one full bag. So then he might say that, okay, in that case, the rate will be 30 rupees. It might actually go down to even lower than 30 rupees. So that is what is economy of scale. So variable cost may vary with economy of scale. As you operate your business and the turnover goes up, your raw material purchase on a monthly basis goes up, So you may end up enjoying the economy of scale. But this is also considered fixed because you do not know how much percentage benefit you may get. So to be able to estimate the break-even point for any useful purposes, you need to assume them to be constant. Otherwise, if you start capturing all the variations, you will get lost. Of course, there can be mathematical model. I don't know whether anybody tried to build them. There can be mathematical model using which you can meaningfully forecast all the elements of the variable cost, like how the salary will go, not salary, wages will go up, how the raw material cost, what is the trend of price of raw material and how is it going to go up, you can forecast. So with more application of statistics, probability, you can actually make it more accurate. And then you can have the model built, the break-even point analysis built based on statistical model, and then you can make it more accurate. But for the time being, we are not actually discussing that. And therefore, our break-even point analysis that we have been taught or I have been teaching is approximate to that extent. Now, the third one is a significant approximation. That is, whatever you produce, you sell entirely. In reality, you may not be able to sell in entirety, so there will be some inventory buildup. Now, how much is the inventory buildup? You do not know. It's futuristic. So to avoid all those uncertainties, we assume that whatever we produce, we sell everything at the end of the year, nothing is left. So in the balance sheet, the inventory will be zero, which is normally not the case. If you remember, when we prepared balance sheet, we have some inventory of raw material, inventory of finished goods. Even in big companies balance sheet, there will be inventory of goods in process also. But in case of break-even point analysis, we are assuming whatever raw material we bought, we have consumed it in entirety. Whatever finished goods we produced, we sold everything. So these are approximation, and these are the limitations also. Then product mix. Suppose you are manufacturing pen, you are manufacturing pens of different varieties. Now, suppose in the first month you have produced, say, 50% good pen, 25% medium pen, 25% low quality, cheaper pen. Now, moving forward, if you change this mix, then your variable cost per unit will change. Your selling price, average selling price will change. So you won't be able to estimate. That is why it is assumed that your product mix remains the same. At the beginning only you estimate average raw material cost, average selling price, average variable cost, and you assume that this will remain constant. Otherwise, this is going to be problematic. Okay, now after knowing all the limitations, even the question may be like this, that there are so much of limitation. So is there any utility of break-even point? It may not be as simple as that. Point is that break-even point gives us a good insight about different businesses. And we presume that all the limitations will be similar across different companies. And when you make a comparison between different companies, since all the limitations are getting squared off, or say, when you compare two things, the limitations will get cancelled, and we get a fair idea, a fair comparative idea between different companies. 1, 2, 3, 4. Okay, so remember this sentence. I'm just saying it's off the cuff. I didn't plan that way. So even though there are limitations, because break-even point is used primarily, not always, primarily to understand which business opportunity will give me no profit, no loss situation at a lower capacity utilization or lower level of operation, and we are making comparison between industries, the limitations will cancel each other and we get a fair idea. Fair means it serves a fair purpose in that regard. That is why break-even point is very important. Now I want to explain this in detail. Classification of some regular cost item. Normally I don't remember which are the costs, so you may have actually in your sum. I'm going to give you a list of expenses like the accounting example. I have given you many cost items and then asked you to estimate gross profit, operating profit, net profit, etc. Here I may give you some 10 items of cost. Say I give depreciation, insurance, etc., 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 without saying which is fixed, which is variable. Now you have to estimate all the fixed costs separately. That becomes your annual fixed cost. Remember this, fixed cost is on annual basis, whereas variable cost is on per unit basis. But I am going to give you data on annual basis. Okay, suppose I say that raw material consumed during the year so and so is say 3,000 rupees. Now your job is to estimate, sum up all the variable cost first, annual variable cost, then divide that with number of units that we produced and sold to get unit variable cost. Variable cost is based on unit variable cost. Similarly, selling price per unit is S, and that is the thing that we use. Okay, so if we give so much of data, then actually the better idea would have been to do a sum right away, but then I don't know, I didn't actually plan that way. I should have planned that. In the next tutorial I'll be planning that. I'll have at least one more tutorial, and that will be a lengthy one. Perhaps I'm going to cover all of it, whatever numericals I have done and whatever I'm going to do moving forward. There may be another topic involving numerical, particularly the cash budgeting, or say project. It's called cash budgeting, I believe. I forgot the name, but that is always a compulsory part of the course. I don't know, because this time the number of lectures are limited, means shorter, so I may not be able to complete that. I have a catch-22 situation. I can complete, like I can give extra classes, but many of you may not like it. Many of you are interested about scoring good grades and not to really learn too many things. I don't blame anybody. I was a student at some point of time. I used to think like you guys. So you guys are the average of IITian. So I was also average of IITian. So I can understand that. That is why sometimes I offer additional lectures during the summer. Last time I offered classes on finances. That was 33 students actually participated. Out of that, 20 students took it as a summer internship. So 20 students took that finance classes at summer internship. And I gave them certificate, and it was okay because they could not manage summer internship. This time I'm not planning because it becomes too hectic. And I don't know, even today I had selection process going on till 12:30. I have started immediately. I'll start again at 2:30. So in between I have to have my lunch. So you can imagine the kind of program I have. So this time I'm not solving anything. So let us, you should understand this. Let me explain why these are fixed, why these are variable. That should be good enough. See, fuel cost, take for example fuel cost. Fuel cost is proportional to number of products that you produce. If you produce more product, you need more fuel, less product, less fuel. That is why this is variable. It varies with the level of production. Whereas depreciation is fixed because it is no way related to number of units produced. Rent also is fixed. Of course, if you produce too many units, then you may have to rent another room, but that is an exceptional case. We don't consider that. That is why the assumptions and that is why the limitations. But generally, rent is fixed. Say ROC registration. It is always fixed because you have only one company and you normally don't pay more registration fee. Of course, if you raise investment, then your paid up capital is going to go up, authorized capital is going to go up. You may have to pay a higher ROC rate, but we don't consider it now. For any future purposes, we take all of that as constant, right? Just like depreciation, then salary. Okay, interest on long-term loan. Long-term loan is raised for on a long-term basis, even though interest on that will go down as you repay the loan, and you are supposed to repay on a monthly basis. But still, this will be considered as fixed because it's a 7 years loan, 5 years loan, etc. So let us not go into all those details and all those finer details. So we'll consider interest on long-term loan as fixed, interest on short-term loan as variable, even though it will be the other way around, but forget about that. Let me not confuse you by saying all of that. See, stationaries is the amount that you pay for printing bills, voucher, letters, maybe letterhead pad and other things. These are all stationary items. So usually that remains same. Normally with level of production, it does not vary. But it is assumed that the more you sell, the more invoices you raise. So that is why it is always considered as variable cost. Stationaries, electricity bill, then printing also, whatever it is, we consider that as variable. Just don't bother your head, just know that they are variable expenses. Now production bonus, this is something very special, and production bonuses are given proportional to the productivity. Suppose this month productivity is better, so you pay some production bonus. Next month productivity goes even further beyond that, you produce even more, so you pay more bonuses. That is why production bonus is considered to be variable. Traveling expenses, the more you produce, the more will be marketing people traveling from one vendor to another, one distributor to another. So variable, this is variable cost because it is proportional to the level of operation. Now there will be some items among the items that I give which are not expenses or cost. So you should be mindful about that. Say dividend. So here your profit loss account that we learned during our profit loss account statement and balance sheet classes will be handy. Like dividend comes after you estimate profit. So this is not a part of expenses. Interest is part of expenses because you see expenses ends before you pay income tax. Income tax is not an expense. Income tax is not a part of expenses. Remember this. I may put income tax, dividend, things like that. There may be more items which are not actually cost, but it will look like these are cost. So remember that dividend is not cost. Income tax is also not a cost. It's given here, not a cost. Okay. So if you know all of that, then estimating break-even point is cakewalk. But then it is not as simple as this one. Whatever example I have given, it is not as simple as that one, like this or this. So I said selling price is this, variable cost per unit is this, everything is given. There, everything will not be given. You have to estimate. Like if I say that the sales of a company during 1991, sorry, say 2019, 2020 is something. Then I'll say variable cost of the company during the year is as follows. Then I give raw material cost, then this cost, that cost, not variable cost. All the cost is the cost, total cost of the company is given below. So you have to identify fixed cost, then identify variable cost. Whatever is the total fixed cost, that comes here, where in the next slide, fixed cost. So that will be this one. Then you have to estimate the total variable cost. And I'm going to tell you that number of units manufactured and sold during the year is this. So you divide total variable cost by number of unit, you get unit variable cost. You divide total sales by the number of unit produced and sold, you get selling price. Then you estimate the BEP, that is the total fixed cost during the year divided by selling price per unit minus unit variable cost, and you get the break-even point, number of units that you have to produce and sell so as to break even. What does it mean? If you produce and sell 2,823 units, then you are neither making profit nor making loss. Why this is so important? This is very important. As to why this is very important, because future is very uncertain. Startups have so much of uncertainty. Now, if you know that the market situation is such that selling 3,000 units would be cakewalk, you know that selling 3,000 units is going to be cakewalk because you already have established connectivity with some of the distributors, some of the people, and you know that goods are moving pretty fast. Now, if you see that break-even point is 2,823, you can immediately feel comfortable that, okay, so if I sell 3,000 units, I'm going to make some profit. I'm not going to incur loss. That gives you so much comfort, and then you choose that business model. Whereas suppose you see that break-even point is something like 2,500, and if you produce and sell beyond 2,500, only then you are going to make profit. So then you have a different perspective. So with that actually is helpful for us. Oh, sorry, I don't know whether I have given you the complete picture correctly. You feel that you can sell very easily 2,500 unit, not break even. I'm sorry, I think I was actually looking outside and talking. Suppose you feel that selling 2,500 units would be a cakewalk, but beyond that you have to really make attempts. And now you estimate the break-even point and see that break-even point is 2,823. So you will be concerned that after 2,500 I am very comfortable, but beyond that I'm not very sure. So now you have to think how difficult it is going to be to sell beyond 2,823 units. Depending on that, you make a selection. Now, alternately, you have another business proposition where the break-even point is 5,000 unit, and you are very comfortable that selling 6,000 unit is kind of cakewalk. So obviously, even though break-even point there is higher at 5,000 unit, but because you are comfortable that you can make a sales of 6,000 very easily, that business is more attractive compared to this, though here break-even point is only 2,500. So I may place a question like this, that suppose I give some statement, business 1, 2, 3, 4, and give that these are the break-even points of these businesses. Then I give some qualitative questions that from the above, can you make a decision about which business is the most attractive? Maybe I'll give some mix of information, and then you have to make a decision as to which business is the best. There will be limited scope for subjectivity. If there are subjectivities, then of course I may not give that kind of question, but then there will be some subjectivities to the extent that I'm discussing, not beyond that. Whatever knowledge I'm imparting, using that you should be able to answer. So, but then if you do not have this perspective that there are so many things to think, then it may be difficult to understand. So here I'm going to give you a lot many items of cost, where some of the items will be balance sheet items which are not part of cost, like inventory. I gave inventory of raw material, closing a stock of this, something like that. So don't use them. Why? Because they are not cost, they are not expenses. I am using expenses and cost interchangeably. That is how people do. But if there is a question, even in my exam, if there is a question that whether cost and expense are the same, answer should be no. And you should understand what they are. Cost is the money that you pay to procure something. Cost is the money that you pay to procure something. Expenses or expense is the money that you have paid for the items that you consumed, not you bought. Suppose you bought 1000 units during the year, but you for say 10,000 rupees. You spend 10,000 rupees to buy 1000 units. So cost of procurement of 1000 unit is 10,000 rupees. But now during the year you consumed say 700 units. Rest of the 300 units remain in the stock. So what is your expense? Your expense is 7,000 rupees. 700 multiplied by 10. I'll take a call. I don't know from whom, but sometimes they may be important. Just excuse me. Hello. Yes. আমি একটা ক্লাসে আছি, একটু পরে ফোন করুন। আমি একটা ক্লাসে আছি, একটু পরে ফোন করুন। Sorry, so it's not so important. Now you should understand that clearly. Later, don't tell me, don't blame me, and don't show me the video where I have been interchangeably use those terms. Most of the people do that, but then there is a clear distinction, and it is not for nothing. It is for a purpose, and it actually they carry meaning, sense. So that is why they are important. Okay. And contribution margin is another one, and normally I put a question from here. Contribution and contribution margins are two distinctly different things. Unit selling price minus unit variable cost is contribution margin. That is unit contribution. That is contribution from single unit. So if your selling price is 800 rupees, and if your variable cost or variable expense per unit is 700 rupees, your contribution per unit is 100 rupees, 800 minus 700, which is contribution margin. So remember the distinction between contribution margin and contribution. Suppose you have produced and sold 100 unit during a particular year, and your selling price is 800 rupees. Your variable cost is 700 rupees. Now the question is, what is the contribution and what is the contribution margin? So just you can expect a question slightly confusing, but unless there is little bit of confusion, it is very difficult to understand who understands the subject and who does not. So my objective is to know how much you know. So obviously there should be little bit of a twist, but you have already seen my question. They're not twisted so much. Okay, but then you should have a deeper understanding of the subject. That is what is desired. So in this example, you have produced and sold 100 unit, and per unit contribution is 100 rupees, 800 minus 700. So contribution margin is 100 multiplied by 100 units total that you sold. So 100 into 100 is 10,000. 10,000 rupees is the total contribution, whereas 100 is the contribution margin. Remember this. And this is not important only for these purposes. This is important for a deeper purpose. Let us look at the graph to understand this. See, let me remove some of the things. Okay. Now look at this green line. This is the sales line, meaning this is a line that represents your sales. If you sell only 0 unit, the sale is 0. This line is sales and cost. So if you produce and sell 0 unit, your sales is 0. As you move forward, if you produce and sell 2823 unit, your sales is here, whatever that is at that point, and this is the variable cost and this is the fixed cost. Two together, this is the total cost. Now you should know one thing for good, that is the slope of this line, the slope of the sales line represents the unit selling price. If you have not noticed it, notice it now. The slope of sales line represents the selling price of one unit. So remember, if I give the slope of the line, that is the selling price per unit. Okay. The slope of variable cost and the slope of total cost represents unit variable cost. Okay. And the difference between at any point of time, suppose you take any line, you draw any vertical line. Okay. And then you draw any vertical line. Wherever it touches the variable cost line, total cost line, wherever it intersects the total cost line, this point, and wherever it intersects sales line, this difference is the total contribution. This difference is the total contribution. Let me know. No, this is not the total contribution. This is the profit actually here after break-even point. So sales line is a total sales, total variable cost. It should be here. This is the total contribution. For a moment I got confused. This is the total contribution, but the difference between the total cost and the sales is the profit. Okay. Is the profit. So from here, from break-even point, if you move upward, suppose your sales is 2823 at present, or break-even point is 2823. Suppose your selling price is 800 rupees and variable cost is whatever. Variable cost is, what is the variable cost? Say 557, say 700. Let us not go into all this detail. I'll have confusion. Say your selling price is 800 rupees and variable cost per unit is 700 rupees. Now, once you break even, meaning you have already sold 2823 units. So you have achieved break-even point. That means you have met all the fixed cost. Beyond that, you don't have to meet any fixed cost moving forward. Remember this is very important concept. Break-even point is the point when the contribution is equal to total fixed cost, meaning whatever is the contribution, What is the contribution? If you look at the graph, you will know that this is the total contribution. It should be this, but why is it coming like that? I'm thinking. This is the fixed cost. So this is a sales line, this is a variable line. So it should actually be here. Variable cost minus sales is the contribution. And the contribution should be is equal to fixed. Right. No confusion. Please let me show you with this. Say this line is here. This is slightly fatter. I think some of you has already got the answer because many of you are smarter than me. Yeah. So this is the fixed cost, right? Sorry, this is the contribution. What is the, this is the, sorry again. Remove this. Now what I said is this is the contribution, that is the difference between sales and variable cost. Total sales minus total variable cost. The graph represents total sales and total variable cost when you produce and sell these many units, right? So the difference is the contribution. Now you bring this line here and see the fixed cost. It is exactly the same. This is the fixed cost. From zero, this is the zero line, and this is the fixed cost line. The difference is the total fixed cost. So this is the contribution which is equal to total fixed cost. So let me put it here. Okay, total fixed cost is equal to the contribution. So you meet all the fixed cost at this point, at the point of break even. See, when I teach, even when I teach, I don't think all of that. So while deliberating, I'm just, inventing what all these means. So this is what is, this is a point, that is how, this is a point when you meet all the fixed costs. The formula also says that. Where is the formula we have? See, yeah, fixed cost, and when you meet all the fixed costs through contribution, S minus V, when S minus V into Q becomes is equal to F. At that point is the break-even point, right? You get this point, I believe. Let me, is there a formula? No. I won't be able to edit. This is so simple. Suppose insert equation. You just bring it here and it's done. I don't really need to do so much. But since I have started now, I have to complete. So if you multiply S minus V into Q, that is the contribution is equal to F. So I don't have to do it actually. Get this point? You just multiply S minus V into Q. This is nothing but total contribution, which is nothing but is equal to fixed cost. From here also you can see that. Yeah, this is perhaps formula. No. I think you have got it. So Break-even point means the point when the total sales is equal to total expense. That is number one. Number two, break-even point is the point where fixed cost is equal to contribution, total contribution. Remember this. This may also form a question. There may be multiple options where one of the options will be break-even is the point when total fixed cost is equal to contribution or total contributions. That is the correct statement. Okay, so I hope you understand that. No, that is not the point I wanted to mention. The point that I wanted to mention is, suppose I say that break-even point of a company is 2,823 units. Their selling price is 800. Their variable cost is 700. What will be the profit if the company manufactures and sells 2,824 units? The answer is, I believe all of you understand, answer is 100. Why? Because when you produce one extra unit, your selling price is 800, your variable cost is 700, contribution is 100, and now all the fixed cost has been already done, meaning already whatever you have incurred, you have already made good. Now, whatever is the contribution that goes to profit directly, there is no fixed cost anymore. Now, if I say that you produce 2,833 units, so your contribution is 100, 100 into 30, 100 into 10, because you have produced 10 units beyond break-even points. So your profit is 1,000. You don't have to do all the mathematics to estimate profit. If you do that estimation, you can find out, but you will end up wasting time. Don't do that. If I give a sum on this, then it is going to be demanding time for shortcut, not really that long lengthy process of estimating. Okay, that is about everything about break-even point. Now there is something called margin of safety. It's very simple and there is not much complexity there. If you know the break-even point and if you know where you are going to operate, if you think that we are going to operate at 5,000 units, then 5,000 minus 2,823, which is the break-even point, is the margin of safety. Why margin of safety is so very important? Because businesses are fraught with risk, uncertainty. You do not know when the market will become difficult. Like at present, we know that COVID is going downward and we are expecting that IIT is going to call all the students very soon. But you never know. There can always be a second wave. And if there is a second wave, we do not know. Similarly, for business also, if there is a second wave, business may go down. So we always try to minimize our risk. If the margin of safety is very high compared to break-even point, that is part of minimizing the risk. So there can be a question about risk and margin of safety. So remember this, there is a correlation between risk perception and margin of safety. Safety meaning connected to risk. So suppose your break-even point is 2,800, margin, you are selling 5,000 unit or you are projecting. Maybe the market goes down. Suppose there is a lockdown and you lose production for 10 days or something. You may not be able to produce 5,000 unit, but you may produce 4,000 unit. So you are still above break-even point. So you're not going to incur loss. But suppose your break-even point is 4,200 and your break-even is 4,200 and your production plan is 5,000 unit. Now you are overly sensitive to the market ups and downs or vagaries of the market. Meaning that if the market situation becomes worse, then chances are high that it may go, your production may go down below break-even point when you're going to incur loss. Just as I said, beyond break-even, if you produce a single unit, you make profit is equal to unit marginal unit. What is that? Contribution. Contribution margin, meaning 100 rupees. Similarly, if your production goes down by 1 unit, your loss also is equal to the contribution margin, whatever is the contribution per unit. So if your planned production is 5,000 and if your break even point is 4,200, you would not like to be in that situation. That is why margin of safety is important. So among 3-4 businesses, wherever margin of safety is good, you would like to tell that, you would like to take up that. Now there may be a situation where the break-even point is at a lower level, but margin of safety is very high. You would like to choose that business. So now you can get what kind of a question you can expect, where both break-even point, contribution margin and margin of safety, all three can be a component in a single question. Okay. Sorry. So these are assumptions. Assumptions are very important. You should study the assumptions and remember, if something is not to be memorized, I'll always tell you that you don't have to memorize. Assumptions are important. You should understand, and that will help you to memorize. And limitation I have already discussed. One more important point, two more important points I'll discuss and then wrap up today's lecture. One is degree of operating leverage. I have already explained, but let us explain more. See, degree of operating leverage you can understand from here, and this is a very good depiction. And you should understand when degree of operating leverage actually is more meaningful. Suppose you are operating, say, at this point, Now, if you are operating above break-even point and your option is you want to utilize degree of operating leverage as a decision tool, then you definitely understand between two businesses, if one business has higher degree of operating leverage, then that is preferable, because for every unit that you are going to produce, that is going to translate into higher profit. But if you are operating at a break-even point, and the question is, if you are producing 1 unit less than degree of on a unit less than break-even point, then wherever you have higher degrees of operating leverage, that is going to lead to higher losses. Just as it leads to higher profit for unit production beyond break-even point, it will also lead to higher loss if you sell anything beyond break-even point, below break-even point. This is to be understood very thoroughly. I am yet to share the slides. I'll share it after I correct that. I think I need some corrections to be done. I am yet to do that. So look at this. This is the variable cost. This is another variable cost. If the fixed costs are same, then you can see that here the margin contribution is more, where you have a higher degree of operating leverage. Whereas here you have less contribution margin and you have less degree of operating leverage. For each unit you produce and sell beyond break-even point, you make less profit. Whereas here you produce and sell every additional unit, you make more profit. Now you change the situation. You increase the fixed cost. Your break-even point might be here. No, this is not that kind of an example. Let us move forward. I'm feeling tired after the whole 3 hours of grueling. Yeah, look at this. This example is not an ideal example. Say in one context, this is a fixed cost and this is the sales. This is the variable cost. In another context, this is the fixed cost. The higher one is the variable cost. So this line is the total cost. This line is the total cost. If this is the total cost, this is the sales, your break-even point is this. Break-even point is slightly ahead compared to if this is the fixed cost and this is the variable cost. Break-even point is lower. This, I think, is a unique example. I wanted to convey this message through this example. Here break-even point is higher. Here break-even point is lower. But look at the contribution margin. Here contribution margin is this. Here contribution margin is a small one. So in this case, your degree of operating leverage is higher compared to this one. So degree of operating leverage indicates that for each unit, additional unit produced and sold beyond break-even point, you are going to make more profit. Yeah. Compared to the other one, even though break-even point may be lower. So degree of operating leverage, break-even point, contribution margin, everything together can have one sum. So you should be careful about that. This is a good example. You can read them. Let me explain this one. I don't have really energy to talk more, so I'll finish off in 5 minutes. I don't know whether you understood this or not, but try to notice the difference between the break-even graph or reference frame, like the XY axis. Here the x-axis is the quantity produced. Here also this x-axis is the quantity produced and sold. I need not write number. I can write quantity very well. Quantity or number of items produced and sold. X-axis is the same. Whereas the y-axis is different. Here it is either cost or sales. If you are thinking of the fixed cost, then it is cost. You are thinking of the variable cost, it is cost. You are thinking in terms of the total cost, it is cost. But if you are thinking of the sales line, then this is sales. This line is sales. Whereas in this case, it is not cost or sales. It is profit. It is profit. So if you draw, for example, suppose this line is not there. Imagine that this line is not there. You have just one line. What does it indicate? You produce 2000 units. It is not starting from zero. So if I shall extrapolate this line, sorry, it's not getting extrapolated. This line would look like this. And the x-axis would look like this. So at some point of time, this is going to give you loss. Yeah. So whenever it crosses here, it goes down, then it gives you loss. Right. So the graph should have been like this. So where this is, and the y-axis should have been here, say somewhere here. That means if you produce 0 unit, you incur loss. Something like this. You produce 0 unit, incur loss. You come here, this is your break-even point. And then after that, if you produce 2000 unit, this is your profit. More than 2000, this is the profit. 17,000, this is the profit. 32,000, this is the profit. That is how this graph is. That is the meaning of the graph. Similarly, we have another business proposition. Yeah, here. So we have another business proposition where the profit is moving faster. So that is the meaning of this line, two lines. For this business, profit is increasing slightly slower. For this business, profit is increasing faster. The slope of these lines indicate unit profit. If you sell 1 unit, how much profit you make beyond break-even point. That is the meaning of the slope. Now, look at this. At this number of units, suppose this is how much? 7,000, 12,000. So this should be something like, say 9,000. Say 9,500, because the difference is about whatever, say 10,000. This is 10,000. When you produce and sell 10,000 unit, the profit from both the businesses are same because they are intersecting. If the profit is same, if the sales are same, that means total cost also is same, because you are selling 10,000 units. Selling price has to be same because two products, identical products, will not sell at different rates. So sales are same, total costs are same, profit is same. So this is a place when everything is same. Now, suppose you are operating slightly lower point, at a slightly lower point. Say at this point, say at 7,000. You are operating at say 7,000. You are in an industry where you think that selling 7,000 units is kind of some work, meaning it's difficult to go beyond 7,000 units. Understand clearly that if you think that selling 7,000 units is going to be quite okay, but beyond 7,000 it is going to be difficult. In that case, the business proposition represented by the orange line is better because it is giving you more profit at this level. Look at the profit, it is higher than the profit given by the green line. But in case if you think that selling 27,000 units is going to be cakewalk, in that case your business proposition represented by the blue line will give you higher profit. Look at the line and look at the profit line, it is much higher. It starts from here and it's like this, which is quite high. This is the profit. Okay, this line is the profit. So it depends on where you expect to operate. There are many businesses where such a volume is not expected. Suppose, for example, you are selling, say, shirt. You are selling shirts for men. Now, if you are selling very high quality shirt, high price shirt, this is not a high moving item. You may not expect to sell a million shirts because we are a developing nation. We have limited number of people at the upper part of the pyramid. We have more people at the lower part of the pyramid. So you will be expecting to operate somewhere here. Now suppose you are selling, on the contrary, you are selling a very entry level shirt of say 500 rupees or 300 rupees. Now you expect that at 300 there will be many customers. So I am most likely to operate at 27,000 units. In this case, you should expect this business to give you more profit compared to the orange line, the business represented by the orange line. I hope you understand that. If you understand that, you will be able to answer any question. But if you do not understand that little bit of a difference, then it becomes difficult. I hope I have discussed everything that is necessary to be able to answer all the questions that I may set. Now, if you have specific questions, then I'll be glad to answer. So I have stopped sharing and you can go ahead and ask me question. Okay. Any question?
Sir, what is about the semi-variable expenses?
See, semi-variable expenses are like this. Say, for example, insurance. Normally, you have plant machinery building that you insure. There will be a separate policy for insuring your fixed asset because those assets remain fixed.
इसको
So
बाद
there
में
will be some
वो कर लीजिएगा जब पावर
premium for
आ
that
जाए.
part.
Yes,
Vaibhav,
please.
please keep quiet. Vaibhav, your turn will come. Now, for raw material, if your production goes up, then you need more raw material. So insurance policy premium will vary depending on how much raw material you maintain. So that becomes variable. So that is why insurance becomes semi-variable. But for our purpose, because this is not an accounting class, for our purpose, we'll keep that fixed. We'll not keep that as variable expense. So you don't have to worry about it now. You consider that as fixed cost, same as maintenance cost. This will remain fixed. Yeah, Boibo wanted to say something? Or you were talking?
Yes, sir. So actually, this I had the doubt regarding degree of operating leverage.
Come again?
So I had doubt regarding degree of operating leverage.
See, degree of operating leverage is, as it is defined, it is the ratio of variable cost to fixed cost. Meaning that
Yes.
if the variable cost is very high, then your degree of operating leverage is low. Why? Because after you meet the fixed cost, for every single unit of additional sales, you earn the difference between selling price and variable cost. So if you have a high variable cost structure, your margin, or what is that, operating margin,
Operating
is
margin.
less. So that is not a good proposition. Whereas if your degree of operating leverage is more, that means for every additional unit sell, you are going to make more profit. That is why it is desirable to have a higher degree of operating leverage.
Yes, sir. Okay, got it, sir.
Okay. Anybody else? Shiva Krishna wanted to ask something. Jasmine, your light was glowing, so I don't know. Okay.
Hello, sir.
Yeah, go ahead.
Sir, any difference between contribution margin and operating leverage, sir?
Like operating leverage is a leverage. It's not really called a margin. You have rightly pointed out, but contribution margin is a straightforward difference between selling price and variable cost, unit variable cost. Whereas degrees of operating leverage is expressed with a separate formula. It is not unit variable cost. It is not the difference between selling price and unit variable cost. The definition itself is different, but philosophically, practically, they tends towards the similar kind of a comfort that a company enjoys. Yeah, Shubdeep, Shubhadeep, you want to say something? Got it? Shubhadeep Pal replied to your conversation. What is that? Okay, Shubhadeep wants to ask why depreciation is a fixed cost and not a variable cost. Because look at it on an annual basis. See, in a year, whether you produce more or less, depreciation remains the same. Depreciation is estimated on an annual basis. During the year, depreciation will not change. It may change in the next year if you are following declining value method of depreciation. But normally, if you follow a straight line method of depreciation, depreciation also remains the same over the years. At least for 1 year, it is not varying. So you consider depreciation as fixed universally. There is no confusion about that, and no book will tell you that depreciation is a variable cost. So assume for the time being or for good that depreciation has to be fixed. There is no scope for it to be variable. Okay, anything else? Any other question? If not, then I'll call it quit. So I'm stopping recording first.